Okay, so today we'll be discussing an indicator referred to as the CCI, okay, the commodity channel indicator, CCI. And this indicator is mainly known to determine or assist traders identify area of divergence. That's in identify where there is divergence. Now, what is divergence? Divergence, let's assume we have two scenarios, A, B, scenario 1, scenario 2, A, B. Now, A stands for our chart, this chart now. If the chart is moving upwards and the indicator is moving downwards, we say we are experiencing some divergence, okay? Conversely, if the chart is moving downwards and the indicator is moving upwards, again we are experiencing what? Divergence. But if the chart is moving upwards and the indicator is moving upwards, there is no divergence. If the chart is moving downwards and the indicator is moving downwards, there is no divergence. Divergence implies that there is some disagreement between the direction the chart is moving and the direction the indicator is moving. Okay? Now, when we talk of divergence, in this particular scenario, I'll be explaining the bearish divergence. Okay? For the bearish divergence, we are trying to identify area where sellers would have the dominating presence, okay, where we are expecting price to do what? Turn in favor of the sellers, okay, in sellers' favor. Now, for the bearish divergence, is simply divergence in favor of the sellers. This bearish is a connotation that means that sellers are in control. So for bearish divergence, we are connecting tops. I'm going to treat another one for bullish divergence, okay? So for bearish divergence, we are going to connect tops. So I'm just going to do an overview of the steps to create an idea of what we'll be looking out for. Then I would use a chart to explain in total what actually we need to do, okay? So without much ado, let's look at it this way. Step 1 is, what do? You use vertical lines to mark up important points. Let's say on the chart we have a point, but you cannot really know if the point you're seeing on the chart is important. It is an indicator that will let you know if the point on the chart is important because of the peak. Don't forget we are connecting tops on both the chart and the indicator. So once you notice a peak on the indicator, you put your vertical line to correspond to any candle it runs through on the chart. Okay, once you've done that, we have gotten the primary point. We'll move to the secondary point and repeat the same process, nothing different. Then you use horizontal lines, though I'm going to do this on the chart as well, to identify where once price starts coming back, if it is the indicator that it crosses the horizontal line before the chart or vice versa. Okay, that is if the chart crosses before the indicator. You use trend lines to do what? Connect bodies, not wicks. We don't connect wicks, we connect what? Bodies. Am I making some point here? You just reserve your question for now. I will address all your questions. Just you can put it down on a sheet of paper. By the end of this, I will treat all your questions. I will take my time to repeat if it requires me repeating everything I'm going to explain. But I believe by the end of the explanation, you'll get a full grasp of what I'm trying to paint here. Okay, now we are connecting bodies. So body on the chart with another body on the chart, then the peaks on the indicator with another peak on the indicator. While you are connecting bodies on the chart, you are connecting peaks on the indicator. I must stress this. While you are connecting bodies on the chart, you are connecting peaks on the indicator. You are not connecting one peak to another area on the indicator that is irrelevant. You must connect peak to peak. So peak A to peak B on the indicator, body A to body B on the chart. Very simple. Now to activate your trades, this is step 4. This is step 4. To activate your trade, we are going to use pending order, not on the spot trading. We are going to use pending order. This is why you need to be fully attentive before price starts playing out in the direction you have already done your pre-analysis and waiting for price to play out. Okay, we use sell stops. Okay, because we are talking bearish, we are going to be discussing more about sells. I will treat another one for bullish, but let's pay attention right now for the bearish. We'll use sell stops and we'll use 2 pips. You place your sell entry, your sell stop 2 pips below the confirmation candle. Okay, now we are getting too deep and there is no figure to make us digest it easily. So let me skim through this and I'll go to the chart and do a thorough breakdown. Stop loss is between 10 to 15 pips. Okay, take profit 1:1 risk to reward. You close 80% of your open position. Okay, at 1:2 you close the corresponding what remaining position in half. Okay, you close the remaining position as in divide it into to close half of it. So let's say the original 1% of your open trade at 1:1 you close 80%. Okay, at 1:2, which is 2R, the remaining 20% of the 80% that was closed, you're closing what 10% of it again. So total now you'll be left with what 90% to be closed at 2R. So what you'll be left by the end of the day hanging, no, no, closing half of, yes, closing half of 20% that will be left to be what 10%. So you close first 80%, then you close again 50%. Don't worry, with time I'm going to distribute a sample of my built software that helps me to do all these calculations. Okay, now what are the rules? I like keeping things very simple. The rules here are simple. 1, no in-betweens. What do I mean? If you're connecting point A to point B using trend line, but since we are doing divergence, this won't go up, this will go down, so that the chart, the indicator will go up. This is the divergence. You do not connect point A to point B when you have a candle crossing through it. I'm going to use a better image to demonstrate this. Then secondly, you connect tops for bearish divergence. I'll also do this to explain. Do not mix it up, meaning don't connect top on the chart and go to the indicator and connect bottoms. No, connecting bottom on the chart and go to the indicator and connect tops. Very wrong. Okay, with that explained, let us go straight to another important section. Now this section is where I'm going to throw more light on what exactly we are here for. Okay, so let's do this. Let me minimize this to, let's say, 14, and let's go straight to the chart. This is the chart. I'm going to use Euro USD 4-hour time frame. So the next thing we are going to do is to do what? Add the indicator. You come here. This is the indicator. You click it. Then in this search bar, all you need to do is type CCI, Commodity Channel Index. You click it, okay, which is my left. So you click on your mouse, the left button. Now this is the indicator. I repeat, this indicator, I am not using any special, I didn't modify, I didn't customize it. I'm leaving it the way it is, okay? I'm not changing anything on it. So this is what we're going to do. We're going to try an example running through all this explanation that I have earlier done. First, and more importantly, we need to find a point on our chart. The first point, let's look at it this way. Before everything here plays out, let's look at it this way. Now let's assume that this is where we are. Price is still doing what? Rallying. You don't know where you have a peak yet, because at this spot, price is already low. And the first rule for bearish divergence is that you want to connect top on the chart to top on the indicator. So this will not stand as a good, it does not meet our criteria. That's what I'm trying to say. So the next stage we need to do is this. Let's imagine that price is playing out right now. We've gotten a peak here. Okay. Now for this peak, what are we going to do? I'm going to name this peak our primary candle, okay, also known as point 1, P1, okay, primary candle or point 1, P1. Okay, now you need a confirmation candle to be sure that this is a peak, because at this very moment price could keep doing what? Pushing up. So the confirmation candle is you need the next candle to open and close, and on the indicator, instead of it to keep pushing up, let it move away from the current trend of going up to create a kind of a sharp edge. This is what I'm talking about. This kind of edge. Okay? Let it create this peak. That bull's eye there. That is the point. So at first you have your primary candle, but because before you pick even the primary point, you would already know that this is a what? A peak. That's why most times, for instance, if price is here now, I will just say, okay, this is my peak. I'm waiting for the next place price will play. So if you look at this, price is here, this is a peak. The next place price is playing for, you see price is coming down on the chart. Price is also coming down on the indicator, so there is no divergence. Okay, so the primary point is always the easiest one, because you just go to any arbitrary point. This can be your primary point, this can be your primary point, this can be your primary point. every peak you see is a potential primary point. Every peak. Okay. Now, most times it is better to pick the peaks that are above this overbought zone. Like you see here, let me not say above, that are in this overbought zone. Here is the oversold zone. Here is the normal range. Okay. Anyone within this zone up is overbought zone. So most times it's safer to let your primary candle be within the overbought zone, but it doesn't matter, because sometimes the primary point can be here in the normal zone and the secondary point or the divergent candle can be in the overbought zone. So it doesn't matter. The main point is that pick a point and name that point your primary point or candle. Okay? Okay, let's go ahead then. After you've gotten this point, the next thing we want to do right now is to get a secondary point. So now you've used vertical lines to mark up important point. This is one important point, our primary candle. This candle is only primary because you have gotten this sharp edge. Inclination, as in up, the peak, then down. So this is a primary point. For the secondary point, before you go to the secondary point, this is what I like doing. I like placing a horizontal line here. Okay? Place a horizontal line on the indicator as well. Now, because I wouldn't want you to just sit down looking at the chart from morning till night. What if it's a slow day? That means you're just going to be watching price action playing very slowly. For most newbies that don't have the patience, they will quickly want to go and jump into a trade that is not meeting the criteria that is required. So what I would suggest for newbies is, instead of jumping and opening a trade, this is what you can do. You place a price alert here. You come to the indicator, you place another price alert here at this particular spot, which is 216.69. This is what I'm looking at here. 216.69. One alert here, one alert here. Okay. Now what this implies is, since price has deviated from this peak, what you're waiting for now is, if you're waiting for one of two things to occur. Excuse me. You're waiting for if the chart would hit this mark first before the indicator, or if the indicator will hit this horizontal line first before the chart. Now, hitting it doesn't mean hooray, voila, let's go and open the trade. No, it's to bring your attention back to the chart so that you can start preparing for a pending order, which is your sell stop. Open a pending order, your sell stop. So hitting this horizontal line brings your attention to the chart, like those who can make the alert show on their phone, even if you're not even at your desk. As it rings signals on your phone, you can just look at your chart on your phone, but I will not advise you to trade with your phone. Please, let's be professional. You come to your chart and look at what? The chart on the desktop or your laptop or PC, whatever system you're using. Okay, let's move to the point. After you've drawn this and price has crossed here first on the indicator, remember one of these two would occur. The two cannot occur at the same time, unless I don't think even in a volatile market, the two occurring at the same time simultaneously is very rare. Okay, so at this time now, it is the indicator that crossed the horizontal line. So pam 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 pam, you get the alert. This symbolizes that you come to the chart. Now you're waiting for this movement of price on the indicator to cross above, create a sharp edge, okay? Create a sharp edge. It must not really drop below before you know that your setup or criteria is ready. Let it cross above and create a sharp edge. So let us proceed. This is our primary candle. At this point here, when price has broken the horizontal line, if you look closely at this particular point here, this particular point here was almost looking like a sharp point. Look at it. This point was almost looking like a sharp point here. So at this point now, what you're going to do is this bullish candle or green candle or whatever color you're using to represent upward movement will be referred to as your divergent candle, not confirmed yet. Okay, your divergent candle not confirmed yet. It's not confirmed yet because you don't know if price will keep going, pushing upwards. It's only confirmed when price gives you this sharp pin, like a penknife or knife, the peak of the knife, that pointy tip or teeth of it. Okay, something like this. You want this, not this, not this, this. This is what you want. Okay, so for you to be sure that you get this, what you need to do is you wait. Okay, you need to wait. So the next thing to do is you wait to see if the next candle will open and close and give us that sharp edge. Okay, now this bearish candle here opened and closed, and we had what? Another peak. Okay, um not confirmed yet. Okay, now this bearish candle opened and closed and price did what? Still went up. So that means we have not gotten a peak yet. We are still waiting. So with that done, what we are going to do next is this. Excuse me, please. Okay. With that done, what we are going to do at the moment is very simple. We move our divergent candle to the next one. Now let me do this. I want to zoom in so that you get a clearer picture of what I'm trying to do. So this bearish candle becomes our next divergent candle not confirmed. It's not confirmed again because just like before, this pot was looking like the pin. The price did what? Instead of reversing here, went higher. So it's a 50 inside. In fact, I think it's divided into three. It can do like this, go this way flat, go up, or come down. Okay, it can go up A, go flat B, or come down C. What we want when price is at this point is to do what? Come down. Let it create the C, the option C, not the option A where price continues up from this junction, not the option B where price goes and becomes plateau, flat. Okay, this is B. The one where price goes up and comes down, this is C. Okay, this is the one we want. Then again, this is not confirmed until this candle, this particular candle you're looking at here, opens and closes. Once the candle closes, we can now confirm using our indicator if we have the option C, this, which is this peak. Okay. Now, if we have this peak, this becomes our divergent candle confirmed, and a divergent candle is only confirmed when we have this, our confirmation candle. Now, this is where the skill comes to play. You see a lot of patience. You see how many hours you must have waited for this to play out. Patience is virtue in this strategy. In fact, in life and in this particular kind of venture. Okay. So once you have your confirmation candle is what changes a divergent candle unconfirmed yet to divergent candle confirmed. Okay. Now once you have this, this is our ringleader. This is the alpha candle. This is the prime, optimus prime. I think that's what it's called. Okay. This is where you're trading on. So what you will do is very simple. You place a horizontal line at the bottom of this candle. Let me zoom in very well. At the bottom of this our ringleader, you place another horizontal line at the peak of it, the top bar, one at the bottom bar, another at the top bar. What this does is simple. You want to create your sell stop 2 pips below the low of this bearish candle, 2 pips below the low of this bearish candle, and keep at least 10 pips above it. Okay, you're not opening once this candle closes, you open your sell as the next candle opens. No, you're only opening your sell once the next candle breaks the low of this confirmation candle, not the divergent candle, the confirmation candle. Okay, so you're placing your sell stop. The first things first, you can place it at this candle low. Now, I like things being perfect. Okay, so what you can do is place your cursor on this candle, then see this point here. This is open, this is high, this is low, this is close. What you're looking for is one here, this low and this high. These are the two things you're looking out for. Your sell stop will be 2 pips below this low and 10 pips above this high. Okay, so in all of this, just put your eye here first. Let me show you what this low is. As you can see, this low is what? Look here, look here, look here. Bring your attention here and look at the value as it's changing. It's 1.06096. So the entry is 1.06096. Okay. Then now we move to this next point. Look here now, high. What would this value say? Put your cursor again, is what? 1.064. Look at what I'm looking at. 1.06417. which is our stop loss 1.06417, you see, to the teeth. You understand? To the T. Then you want to go up 10 pips. You want to go 10 pips up. Let's go to our formula again. We've gotten our primary point, vertical lines. We've gotten the secondary point. Okay. Now you can use trend line to know that, okay, look at divergence. On the indicator is going upwards. On the chart, price is coming what? Downwards. Again, I must say this. The horizontal line has already let us to know. But using the trend line, for those who are new, please use the trend line so that you can identify the divergence. You see, I could do it without using trend line. Someday you will be able to do it without using the trend line. But first crawl, then you stand before you start running. Okay. So this is going down on the chart, whilst this is going up on the indicator. That is a divergence, diverse opinion. Okay. So the next thing we want to do is, after we've gotten the divergence, we've used trend lines to connect bodies, this body to this body, not wicks. The next thing is sell stop, which is where we are now. Okay, use this meter rule. Okay, place it here, move 2 pips down to know the value, which is, now look at this point, look here, this vertical axis that has values. When it's at 2 pips, look at what it's going to show me. 1.06077, 1.06077. Okay, that is 2 pips for me. Now you want to go 10 pips. What you can do is, look at, you see this is 34.0. 34 plus 10 is 44. So you go up until you hit what? 44. 44.1 is a close approximation. Okay, very close approximation. There is another way which I could use, which is doing the mass on this side. Here you can just do 44, put 0. You see you're on 44 at the dot. The same thing you can do for the entry. But I like keeping it very easy for everyone, especially those who are new, so that they don't, especially those who don't have mass kind of to be doing plus and minus. Let's keep it very easy for everyone. Okay, straight to the point. We've gotten our sell stop 2 pips below, check. We've gotten our stop loss 10 pips, okay, above the peak of the confirmation candle, check. Okay, now the next candle we are looking at is this candle, which is the entry or activation candle. This is a second important candle, very important. I will explain why I said it's important. Now let's put this 1:1. 1:1 means your stop loss, which is 440, and your profit should be the same value. This is the easiest way I can do it, instead of us to be doing move it like this up and down. This is the easiest way. You get one as in at the dot. What I mean is, instead of us doing it like this, that it will be making us to be going up and down, just copy what is here, paste it here, and you get 1:1. Now this value you got here, copy this price value, get a horizontal line, place it here, double click this horizontal line and paste that price value in this text box area. Paste it there. This is your 1:1. What this does is simple. Let me clean this so that what this does is simple. At this 1R, TP1, which is 1:1 risk to reward, should be you close what? 80% of your open position. Okay? You close 80% here. You go 2 pips. Profit, when you go 1:2 now, here instead of 44, you do times 2. But like I said, since I don't want it to be too mathematical, you drag this down. Okay? You drag it until you get 2 here. Let this point here. This is what I mean. Until you see 2. So this is 2R. Okay? Again, we repeat the process. Copy this. Pick a horizontal line. Excuse me. Mind you, I was the one that selected all these properties outside. Look at where you can find all these lines I'm talking about. Trend line, arrow, horizontal line, vertical line, all of them are here. What I just did was, you see, if I pick this now, you see it has shown here, but I don't need that trend angle. You see it has gone off. So you can just select here, add to favorites, remove from favorites, add the ones you want, and you have something like this. Then you can place it where it will not distract you. I put my own bottom here because I want to focus on the chart, not on the aid. Okay, so that is it. So at 2R here, at TP2, which is 1:2, we are closing 50% of the remaining 20%. Don't forget, originally we closed 80% here. Okay, we closed 80% here as price hit 1R here. So that means we are left with 20%. Once price hits 2R, as in 2R, which is 1:2 reward, as in 1% risk versus 2% reward, you close what? 50%, which means 10% will be what will be left. Now, this is something I want to say that is not in this, that is not indicated here. Once you hit one arrow, move your stop loss from here to above this entry or activation candle. So you can keep it just above it. You can keep it 10 pips, okay, but not if you want, you can keep it on the candle peak, as in this top bar itself. It just gives some distance in case of price comes close, spread will not take you out. But I don't see any reason why price will want to come close if it wants to continue down, but to be safe. I no be God, you are not God. So you can't tell if price will come close or spread can make it to take you out before when you're supposed to go out. Okay? So this is what I'm trying to say. At one arrow, you close 80%, stop loss above this. So you've modified your stop loss from the original position here to this point. So this is your new area. So you just do the same process, get this point from here, then move it 10 pips up. This is what I mean. just come here, put your at the peak here, which is 12.2 plus 10. Okay, 22 point this thing. You can even leave it 5, it doesn't matter. The point is you have already taken 80%. So even if price comes and closes you out, no problem. But you don't want price to return and close you out at your original entry here, at your original stop loss. Because if price reverses to your original stop loss, this is what will happen mathematically. At your original stop loss, what will be assumed is that, okay, you have 20% stake. You removed 80. What you will be left to be what? 60% profit, which is better. That's why I said you take 80. If you had closed just 50%, now this is going a little advanced, so bear with me. For those who understand it, good. If you don't, feel free to ask question after this explanation. If you had closed only 50%, if price, no matter how far price goes, if it comes back and takes you out here, since it's 1:1, if you close 50% here, what will be left open will be 50%. If price comes back and hits you at your stop loss, which is half of where you had already taken your profit, it has taken the profit you had amassed or gained before and removed something for the commission you paid to open that trade. Okay, except like for Euro USD that rarely has commission. Okay, and that rarely has spread. You understand? But at all, I think like if it's pound yen, you pay $7 round trip commission, which is 3.5 to open the trade, 3.5 to close it. Okay, as in to buy the trade, 3.5 to sell it back, or sell it and 3.5 to buy. But I'm going a little advanced. If you don't get it, just remember, if you don't get it, just remember to the point where I explained last, which is what? This is the point I explained last. Okay, this was where I was. So close 80%. So even if, and you move your stop loss above this your activation candle. So even if price does what? Hits your stop loss, 80 minus the 20 that was left will be 60%, minus commission or whatever charges you will pay will never take you to less than 50%. Okay, will never take you to less than 50%. So at least you are up for the day by 0.5%, which is 0.5. Okay, you're up by 0.5% of your 1% you opened. Like I always advise people, open 1% to be safe. 1% of your total account means you have 100 chances, and you cannot make 100 incorrect chances back to back. Okay, so 1%, if you make 0.5 in one session, you make 0.5 in another section or more, you've made 1% for the day. That one now we're talking about money management. Okay, and money management, risk management, but let's not go far from the concept of this particular study, which is divergence. But I'm just chipping in this because it's very important to understand this concept of percentage now, so that you would grasp this strategy and milk it effectively. If you leave your stop loss at the original spot and price comes back, even if you have closed 50%, 80% here, 80 minus the 20 that was still left open will reduce you to 60%. I hope I've made myself clear. Now, if you say no, I too get sense, I will only close 50%, that means I'm too wise, I will only close 50. If you close 50% at 1 hour and price comes to your original stop loss here, you are going to be left with minus whatever value, which is the 50, this 50 profit you made will be cancelled by the 50 loss plus the another negative, which is the commission you will pay. So you end up in negative percentage. Okay, with that being said, let us forge ahead. Now, let's assume that you followed everything I said. Okay, let's assume you followed everything I said. You are an obedient listener. You want to learn. So once price hits your 1 hour here, you close 80%, check. You move your stop loss from the original position, which is the peak here plus 10 pips, remember? You move it to the peak here again plus 5 or 10 pips. This is your discretion now, 5 or 10 pips. If you move it only 10 to 10 pips, okay. If you say 5 pips, okay. But the point is that immediately price breaks this high. If I'm you, I will just close the trade. Immediately price breaks this activation candle or entry candle high, the top wick, just close the trade. Now, if let's say instead of price to retrace, price continues going down, you will not touch this stop loss again. You just leave it here. If price keeps continuing down like you see here, you close 50% here, so overall you're still left with 10%. Now the question is, since I'm still left with 10%, when then can I close my trade? Will I just leave it running like that until it will come and hit me as stop loss? No. This is what you're going to do. As you have closed this here, if price keeps printing, watch this. Price keeps printing. Now price is at the what? Overbought, oversold zone. Okay? Remember, this is overbought, this is oversold. Once price comes to this oversold zone, you will do the bullish divergence. Okay? The bullish divergence is what is going to let us know if we should prepare to close our position or not. But for the time being, at 1:2, you close an extra 50% and leave the rest to run. Okay? I hope I'm making myself very clear. I've taken my time painstakingly to explain this particular scenario. Okay? Now, let us look at another example of the same kind of scenario. Just another example. Again, you can pick any arbitrary position, but now I want to look for the one that is a little tricky. Okay, like this. Let me demonstrate that no in between. Okay, now weeks don't count. Put that on the back of your mind, write it down on your notebook, your journal, your jotter, whatever you have. What counts are candles. What counts is candle or candles, okay? This week doesn't count. Meaning, if you say that this is one peak, like I said, peak can be anywhere, You can pick anywhere as a peak, okay? But what matters is the secondary position you pick. That is where we start getting important instructions. Now let me copy this, close, delete everything, beautiful. Then paste this again. I want us to now do the process again. Now you pick this position here, this peak, okay? If you choose this as the next position because you are connecting. Remember what I said, you're connecting body to wick. You come here, connect this to this because as you can see, it's divergence. Chart is going up, price is coming down. You connect like this. This is what will happen. This is why I say you don't connect wicks, you connect body to body. This is the activation candle because why did I say the activation candle? Because this is the divergent candle. You see the next peak. See the next peak here? Here. This dot, backham. You see the first one here, primary peak, backham. Secondary peak, backham. Okay? If you use this activation candle, or as in this confirmation candle, this is our confirmation candle. This is our divergent candle confirmed because of this confirmation candle. Now, if you use this as your confirmation candle, so this will be your activation candle, meaning your sell stop will be 2 pips below this. Your stop loss will be this candle high plus 10 pips. 91 plus 10 is 101.3. Okay, 101. Check what will happen. You've not even get up to 1 arrow. And what do you see happen there? Price came down, gave you hope. Okay. Price came down, gave you hope. Came back in drawdown, dropped again, made you hopeful that it was going to continue, and did what? Came up. There was a point this candle was bearish. You were like, oh, good, good, good. Let it continue dropping. Instead, it went up, created some consolidation here, then took you out. This is already a drawdown of 1%. So you see, neglecting the criteria would result in this kind of failure. What's the criteria? The criteria is that you don't connect wicks or body to wick or wick to body. You must connect body to body. Now, if you were to connect body to body, this is what would have become your eye opener. If you connect this body instead of the wick to this body, there is no divergence because this is coming down, this is coming down. So you would not even be in this trade. You would not be in this trade. Okay? So where you should connect is you come to the next peak here. Here, we have price going down. On the chart, price is still coming down. Remember, since this is not a candle, it's a wick, this is not an in-between. It's only an in-between when you have yep, when you have a scenario like this, you're connecting from here to here. This is an in-between. Okay, so this is wrong, but this wick is not an in-between because it's a wick that is piercing. So it's considered like a ghost, a mirage. It's not real based on this strategy I'm teaching you right now. Don't worry, retain your questions. You have the time to ask me everything. I will attend to all of it. Just flow with me, be typing it and storing it. As soon as I say open it for questions, you flood me with your questions, okay? Then, this is where we are now. Because there is no divergence here because chart is coming down, price is coming down. You want chart to either go for chart to go up and price to come, chart to go up, an indicator to come down, or chart to come down, an indicator to go up. So to go and rest, you place again your horizontal line on the primary candle. Remember, this is your primary candle. Let me label it again. P1, okay, primary candle PC1, okay, primary candle 1 or point 1, P1, point 1. Let's just leave for consistency, let us leave it to be the same, homogeneous. We wrote P1 before, let's use P1 now, okay. Secondly, homogeneous means the same, okay, not heterogeneous, one part different from the other part, okay. Now, this is another peak. You move the vertical line to this bullish candle, okay. So this is our divergent candle, not confirmed yet, okay. Divergent candle, not confirmed yet. It's very important we stress this. Until we have this peak on the indicator, every divergent candle is not confirmed. The only thing that makes it confirmed is when the next candle opens and closes and there is a peak, this point here, this pin here, this bull's eye in the middle of this circle. You see, so like I said before, while on the chart, remember when I was doing the introduction, I said on the chart you're connecting bodies with trend line. On the indicator, you're connecting peaks with trend line. You're not connecting, and I told you I was going to explain this, you're not connecting peak to any arbitrary position in the middle. I said this clearly and I said I was going to show you, I promised, and now I'm showing you. You're connecting peak to peak. So now this is your confirmation candle. Once you have this peak, you type in your confirmation candle. Now, let me make this point clear. Since you are learning and for explanation purposes, I am taking my time to label it. Once you have seen this video once, as in gone through this lesson, sorry, once, twice, thrice, as in the video, yeah, because it's recorded. Once you've gone through the video once, twice, you will not need to be labeling this. You just need the vertical lines, the horizontal lines, your trend lines, and the best indicator you can add is your what? EYES, your eyes. This is the best indicator you can use, okay, with your eyes. So I'm just doing all this confirmation candle, divergent candle for ease of understanding. So once you've gotten your confirmation candle, your divergent candle moves from not confirmed yet to confirmed. So you take this trend line and put where? On the body of your confirmation candle, okay, body of your confirmation candle. Now it can be body of your primary candle to body of your divergent candle, okay, it doesn't matter, like this, because your confirmation candle and your divergent candle most times will be side by side, okay. Now once you've done this, look at what's happening here. On the chart, price is going up. On the indicator, what's happening? So there is opposite motion, counter flow. This is the divergence. Now we'll come to the pending order. So let's say, look at this. We have done vertical lines, check. You have done horizontal lines, check. The horizontal line is used to aid you so you don't sit at the chart for too long so that you'll not be forced to open a trade when you're not supposed to because you see something that appears to be what you want. So you can place an alert here, place an alert here, okay, just like I explained before. If price, like in this case, once you placed your alert here, price indicated you here, but once it closed, you saw that it was a week, you said, nothing. Price rigmaroled, went down, came back. At this point, by then you would have reactivated your alert again. At this point, your alert has activated you. You've come to the chart. Now you're waiting to see if this activates and it shows price has gone up. You're waiting to see if on the indicator price did not break this your horizontal line. It's very important price doesn't break it. It's very important since this one has broken it to go up. It's very important this one stays below. The moment this one also climbs up, the divergence is cancelled because divergence needs up in chart, down in indicator, or vice versa, which is down in chart, up in indicator. Okay, let's go ahead. Now we come to where trend lines. We've done trend line connecting bodies to bodies, not wicks. Then for the indicator, we are connecting peak to peak. Good, check. We've come now, this is number 4. Number 4. In fact, let me do this right now. Let me edit this and put 4 where it's supposed to be. Okay, this is number 4. So what you're going to do now is you have your, excuse me, okay, just one moment please. My hand mistakenly, okay. You have your divergent candle confirmed, check. You have your confirmation candle. This is the rainmaker, okay, the Floyd Mayweather, okay, the money man. This is it, him or her or the number. This is it, okay. So our focal point now will be the activation candle. So the activation candle, you don't know what it is. Now look at this. You see why I said you should wait for a break of this low and put 2 pips below. If you had entered on the open of this and this candle goes up and you've already put your sell stop and it goes up and takes you down, price can keep going up. So you stick to the rule by waiting for the break of the low of your confirmation candle. I can't stress that enough. Okay, so you do this, which is what I will always advise. I know why now. I know why now. I click the escape button. Okay, place at this bottom here a horizontal line, just repeating the same process. Look at here, look at this. Okay, just repeat the same process. Place a horizontal line at the peak here. You get this high, which is, look at here, which is 1.11375. Edit this to 1.11375. The low is, look at this now, 1.10893. 1.10893. Okay, now for this, okay, you put your type this value you see here, which is 1.10893. This is why I use this horizontal line. Type this value for the stop loss here, which is 1.11375. Now this is 48. You move 10 pips up will be 58.2. 58.7 is still a tight approximation. You move these 2 pips down. Okay, so 2 pips down, use this measurement to 1.10886, 1.10886, 2 pips down. Okay, so as you can see, we are below this our confirmation candle. So this is now our activation candle because it's the candle that activated us into the sell trade. Okay, so this is our activation entry or activation candle. Okay, entry or activation candle. Now again, what I said, just copy this to this spot and copy this one out. Now since you're using just one position, it's not like you're opening 2 trades whereby your first trade you use 80% and put 1:1, close it. You open the second trade of that. This is what I mean. It's not like you're opening 2 positions where one position is 80%, the second position is 20%, where the 80% you're closing it at 1:1, 20% you're closing it at 1:2. Since you're using just one position, this is why you use my method. You place a horizontal line here, okay? At your 1:1, since you copy the number from this area, which is the price, you copy the number, enter it in this, double click this horizontal line, you see this value, do Ctrl V, you paste. This is your 1:1. At your 1:1, this is your TP1. So you set an alert at TP1, 1:1, risk to reward, you're going to close 80%. So immediately price hits 80%, you're ready to close it. Don't be greedy. Then at TP2, drag this down, the measurement tool. This is 2. Double click, come to profit, copy, put your horizontal line again, double click, paste, so that you get the exact point. Now for this point, you place an alert. The monthly price hits it, let it notify you so you can close 80%. Now let me state this. This is very important. I state it. Once price hits your 1% or one price hits your 1 arrow, close 80%, move your stop loss from the original position to above your activation or entry candle, which is this candle. Move your stop loss above it. Very important. Once price hits your 2 arrow, close 20%, which is what I wanted to write. Okay, so at TP2, at TP2, which is 1:2 risk to reward, you close 20%. Okay. Now I've already explained the money management side, why it's important to close 80 year than 20 year. Look at what happened. You see that as if I knew this was not even showing. Thank God, you see. So if you had not closed 80% here, now if you had not closed 80% here, once price comes and hits you here, takes you out, all this time you waited will just be in vain. All this waiting that you got, this 2 arrow and this 1 arrow would have just been wasted, and nothing is more annoying than knowing what price would do, did in your favor, you got the profit, but because of greed, you decided to leave the money or return it and even incur loss. So you see these 2 arrow. So if you left only 10%, even if price comes back and closes you here, closes you out here, you'll still be left with 90 minus 10 will be 80%, minus the commission, you'll be around 70 something percent. Let's just say a high 70%, which is 0.7 of your 1%. Or at this 2 arrow, you could close your full trade. It doesn't matter, it's your choice. Okay. Now get this straight. At 2 arrow here, you might even get your 1%. Yeah, mathematically you get your 1% at 2 arrow here. Because if you close 80% here, at 2 arrow, the 20% that was here has doubled. The 20% of your remaining position had doubled to 40% by the time you got here. So by the time you close half of the 20% remaining, hold on. I just noticed on this, you're closing half of it, not 20%, which is 50. Thank you for pointing that out to me in the chat. Appreciate, John. Thank you. So this is it. This is what I'm trying to point out. When you close 80% here, if price runs to this point and you are left with your original position 20%, 20% that was here at 1 arrow times 2 will be 40% here. Excuse me. Close half of it, you have gotten your 80 plus, you have gotten your 1% at this spot. You have gotten your 1% if you close half. So the remaining position, which is 10%, at this spot is actually 20%, no longer 10, because it's twice. If you don't understand it, I will not blame you. This is a dicey topic. I will take my time by the grace of God to delve deeper. At 1 arrow, you have your complete 1%. You close 80, left 20%. At 2 arrow, your profit is now 2 times this 20%, which is 40%. It's just like cryptocurrency. One Bitcoin, which is $10 today, can be the same one Bitcoin to be $100 tomorrow. It could still be the same one Bitcoin that will be worth just $1. It's because of the risk reward kind of scenario. Okay, I'm just using that simply to just give an analogy. Okay, so the 20% that was supposed to be your 1 arrow, at this spot, it is 20% times 2. So what you have here is what? 40%. So closing half of this 40% has given you your 1 arrow and left a runner. So if what is here, which is 20% at 2 arrow, retraces to this point, is no longer 20, it's 10%. Retraces to this point is 0%. Takes you out, It's just you commission your pain. So you've already taken your 100% out of the trade. I hope this makes sense. Okay, so the table is open now. You are free to ask me all the questions you have. Don't forget I've been talking for an hour plus now, so bombard me with your questions. Let me just get water to drink and get a breather. Okay, but I'm here with you. I'm going nowhere. So I hope you understand this process of divergence. Okay, so if you don't worry. Go through this recording. Okay, go through this recording. If you're shy if you're shy asking questions here, just go through the recording. But you don't have to be shy. We're one family here. Okay, I'm going to stop here right now and expect your questions. Cheers. Once again, this is brought to you by Pips Collector. Bye for now.